we're going to go ahead and bring on our next presenter. Our next presenter is John Seville. John Seville is from Acorn Wealth. Okay, now John Seville is the CEO and founder of Acorn Wealth Corporation. Now, Acorn Wealth Corporation is one of the leading stock trading academies in North America. They have, over the last 7 years, worked with thousands of investors to help educate, train, and mentor individuals on how to effectively manage their own money. Now, John, along with his team, has spent the last 11 years mastering the art of technical analysis as a method of finding the trading opportunities in the North American equity markets, using some very unique techniques. Now, using such techniques, John and the other senior traders at Acorn Wealth, they were able to identify exit points on the market prior to major breakdowns, such as that in 2008 and in the months preceding the European Union crisis. Now, let me go once again welcome John Seville from Acorn Wealth. John, you can go ahead and take it away.
Excellent. Thanks very much, mate, and thanks for Jai for having us. It's always great listening to Hubert speak. It's a wonderful presentation, and look forward to kind of taking that forward today and showing you a little bit about what we do over at Acorn. Hopefully my screen's just popping up here for everybody.
There we go. Great. Yeah, you can hear you perfectly. See your screen. Go ahead. Take it away, John. Thank you.
Wonderful. It's a pleasure to always do these workshops, and you know, obviously throughout the year, markets have gone through different stages, and things continue to shift in terms of the paradigms of the market, what's working, what strategies are best. And so, you know, when we run these workshops, it's always interesting to talk about what's new. So today, what I wanted to focus on is one of the key factors that has been working throughout the entire summer and during the winter, but is a key component in any kind of trade we do, which is actually looking at the smart money and how we use it in oscillating versus momentum markets. So I'm going to be talking a lot about that and the indicators we use, and then I'm going to spend a fair bit of time actually going through all of the trades we picked out in the last month, because they've over, I think, it was about 18 different stocks that met the strategy using what I'm going to be showing you today. There's about an average move of about 13.4% over 10 days. So obviously those are the kind of gains we're looking for, and this is what I'm going to show you today, is how to find that. Brief introduction. We started in '07. We are very technically focused. So it's obviously our belief that while the news can shape the market, that often the technicals precede the news, and that whatever the news events usually are coming, smart money usually knows about it first. So rather than trying to figure it all ourselves and go through the laborsome task of the fundamental research, let's let the big boys do that research for us, and let's try and track what they're buying, and when they're getting out. And that's why the smart money is the focus of everything that we do and the backdrop behind every trade. This is how we predicted such things as the crash in '08. And this type of approach applies to all kind of trading, whether it's day trading, swing trading, or long-term investing. It's just going to affect, of course, what the time frame is that we're applying the strategy. So when I talk to investors, we had a workshop here at the office in Vancouver today with a large group of students, and we went around the room and asked like how people are generally finding their trade ideas. And you know, again, coming back to that problem with fundamentals, a lot of people start their trade decision tree by looking at news and things they're familiar with, and talking heads and so forth, and that's fine, that's great. But once you source these ideas, the question as a trader, when we're in the business of trading, is how do we develop a systematic, process-driven way of taking that idea and funneling it into, does it fit our business model as a trader? So you know, if you're a fundamental analyst and you find an idea, well, what P to E ratio are you looking for? What price to book ratio? What's its market cap? You know, what is it in a growth sector, and how do you analyze that? In other words, if we're trying to mimic how the big boys make money, which is through a very algorithmic process, what is the algorithm that you funnel these ideas through? And of course, this is important to have some kind of process where you have a shopping list of what you want in that trade if we're ever going to hope to replicate it. And that's why lottery winners go broke within 24 months, because they didn't have a way to, they never had a way in the first place of consistently making money, so it was a quick gains, quick losses. So yes, these are all good ways to find ideas, but how do we turn trading into more of a business where the strategy is consistent across the board? And this, of course, the whole idea of this then is to not be emotionally committed to any kind of trade, to be purely based on the types of rules you were hearing Hubert talk about, kind of these things that stay fixed, and to not worry about being right on every trade. That's not the main goal. The goal is to follow your rules and to be strategic. And this is why most people do lose, is because they try and think logically about everything and emotionally rather than sticking by kind of a fixed strategy. And that's, of course, why we have all these noise out there to take you off that track. The stock market is a business, and if the big boys out there are going to make $100 million, whose pockets do you think it's coming from? It's coming from everyone out there that doesn't know the rules, that's handing it over, and that's why most people lose. So let's get into the focus of today, which is into the kind of the more finite strategies that we want to relay over to you. If we're going to talk about the way that we go about building a strategy, think about, as we go through this, what exactly is your strategy as a business? There's 100 patterns out there, or more, of double tops, triple tops, Adam and Adam tops, Adam and Eve double tops, Eve and Eve double tops, and all of these different things have small differences which make big differences in how you approach the trade and the probability of its success. So when we're developing a strategy, we want to be very specific about exactly what we want. So what would you draw if someone gave you a pen and paper? Would it be, what do the candlesticks look like? Are they contracting in the range or expanding in the range? What's happening to the volume? What are the trend lines doing? Think of it very specifically, like you were out buying a house. What exactly would that house have to meet your conditions? So when we go out and buy a stock, what is that list? And once we find that trade and we know what we want out of it, what indicators then do we look for to confirm it? And so as we start to get into developing this thought process, I always like to come back to defining what the market is on a very basic level, because trading with a high degree of success isn't necessarily about knowing all the whiz-bang terms, what a spinning top is and a hammer candle and all that kind of stuff. That's great theory, but what you need to know is what actually makes the market move. And if you understand that, you can trade very well without even knowing any of the kind of latest and greatest indicators or whiz-bang terms. That can help, but you need to understand the foundation. So to set the foundation out before we start to lay these more fancy things on top, let's ask the basic question. Who controls the market? Volume controls the market, right? Whoever controls the volume controls where the money's going. So who controls the volume? This is probably not a question that many people are unfamiliar with. It's the smart money. The reason technicals work so well is that once upon a time, what moves a stock ever is that there's more buyers than sellers, or there's more sellers than buyers. So when we're trying to analyze the market and predict where it's going to go, we need to predict movement by predicting at what point in the chart will there be more buyers than sellers. And the next logical question then is to say, well, where did the buyers and sellers come from? Well, the buyers and sellers used to be people. They used to be managed funds. They used to be brokers that would look at a paper every day or turn on the TV at night and digest their news in a 24-hour time frame to make investment decisions. And that affected buying and selling. Now we're digesting news through computers in fractions of a second from it being released, which are then plugged into programs which react instantly. And 70 to 80% now of all the volume in the market is coming from these said algorithms. Computers basically making decisions with no one behind the screen. Now, this doesn't mean they account for 80% of the money, because what they're just simply doing is they're churning it over so much. So if you take $1,000 and buy and sell a stock, you account for $2,000 of volume. But if you do it 100 times that day, you account for $200,000 of volume. So with small amounts of money, you can cast a very big shadow, and that's how these things work. But in order to work, they have to have rules, which is why it opens an opportunity as a trader to build a strategy around it by mirroring the way these rules work. And they're very important because they can cause such things as the flash crash in May 2010, 1,000-point drops, and 1,000-point rallies. But they are reverse engineerable. Because they are just computers, it's really not that sophisticated that we can't tag along for a bit of the ride. What works against us is the much more complex thing of emotions, which we need to avoid. So let's start getting into some definables. We've defined, basically the essence of what moves the market. So what are the rules that they follow, these computers? Well, they don't make emotional decisions. They make decisions through ones and zeros. Does this price equal this? Yes, then buy. Has it reached our target? Yes, then sell. And these types of rules are determined by fixed points on a chart. So I believe that a stock or an index will not change direction unless it hits one of the following three things. That it won't change direction unless it hits horizontal support and resistance, trend line resistance, and a moving average. So it's not chaos, it's organized chaos. And it won't hit one of these things, these defined things, because people might make decisions at random points in a chart, but algorithms don't, because they're based off calculations, which are fixed points in the chart. So if we can accept this, now we can start taking this forward and building it into a strategy. So we know who controls the market, we know how it makes its decisions based on the types of points on a chart we want to identify, and then we can look at what the overall approach is in terms of directions. We've got three directions. So we've got up markets, we've got down markets, and we've got sideways markets, which of course we can make money in all three. We can go long, we can go short, and if a stock didn't change its price for a month, we can make great money there by selling calls and puts on either side of the trade. So directionless markets can also be a way to make money. If we're going to be in the business of trading, we need to be able to identify in a process-driven way, are we up, are we down, or are we sideways? And we want to answer that question. So in other words, if someone says, oh, what do you think of the market? Is it bullish or is it bearish? I have big problems with the way that question is phrased, because that's very subjective. How do you answer that question? By looking at the jobless reports, by listening to what the papers are saying, by what your magic 8 ball was saying when you woke up that morning. It's intangible, and I don't like intangibles when I'm dealing with trading. What I want to deal with is a question and answer that is scientific or process-driven, that you can replicate every single time to drive home that consistency. So again, we know what the market's limitations are, how it will change direction. We know that we've got 3 different directions it can go in. And then what we also want to realize is that now within this decision tree, we've also got oscillation or momentum. So if I draw it out like this, you've kind of got, you think of it like a decision tree. You say, is the market bullish or bearish? And then you think, okay, if the market's bullish or bearish, excuse me, I've done that the wrong way around. Is the market long, short, or neutral? Is the market momentum or oscillation, momentum or oscillation, momentum or oscillation. So we basically can come down to 6 different possible outcomes, and depending on this outcome, then we can determine what is the most probable or highly profitable strategy that we want to utilize based on that decision tree. So if the market is bullish and the market has momentum, what's the best strategy is going to be? I can tell you right now that would be things like cup and handles. It would be flag formations. It would be ascending triangles. Anything where there's an already existing upward movement that's about to break into new highs because the market's making new highs but has the momentum to go further. So this is the kind of decision tree you want to be able to develop for yourself so that you're not wondering what scan to run or wondering what the market's doing. You're simply following a process. Okay, just switch back to my cursor here. So let's define the difference between oscillation and momentum, because I find that this is it is understood, but nowhere near as much as it should be. Most people lose money in the summer months when we go from winter to summer and then back to fall again, because the market shifts between oscillation and momentum mode. Now, how many people do not know the difference between oscillation and momentum? Just throw it out there in the chat box if that's something you haven't really delved into. Okay, quite a few people. No clue? All right, that's what I'm here for. All right, so the difference, just like longs are opposite to shorts completely, oscillation is also absolutely opposite to momentum. So you go and get your Trading for Dummies books and you watch the YouTube videos on how to trade and things like that. Great. But what you're going to be mostly dealing with is people are going to be talking about, and rightly so, talking about moving averages. So let's buy a stock when the stock crosses above the 9 and 20-day moving average. Let's make sure the relative strength index goes up over 30. Let's make sure the MACD histogram is positive. Great, good information. The problem is that works for momentum trades only. Now, if you go and take those same ingredients, that same ideology, and apply it to an oscillating stock, which is half the market, or half the time, won't work at all. So this is probably, if you've ever experienced where you you have a stock that's been coming down, bang, hits the support point, rallies up, probably looks a bit like that, and it crosses over its that moving average that you were waiting for. And you say, great, things are good. RSI goes up over 30 like you were waiting, and then as soon as you get in, bang, stock reverses. You get out of the trade, and you feel PO'd. you feel frustrated because you followed your rules, and it seems like the second that you buy the stock, the market's looking over your shoulder and just ready to do the opposite. Right? I'm sure we've all had that experience, yes or no? And then maybe it goes back up the other direction after you've just gotten stopped out, and that's even more frustrating. The thing is that the market is looking over your shoulder. It knows how you buy and sell. So that the key of an oscillating trade is to sharply break up to attract buying at the best point that the smart money can sell off its position to you, the frustrated trader. So let's talk about what the differences are. So again, what I'm getting at is that with an oscillating trade, MACDs, and its moving averages, RSI in the way that I have described its usage, do not work at all with an oscillating trade. We are dealing with a completely different setup. So in oscillation, we're talking about the most important thing being levels. So I said that a stock can change direction because it hits a horizontal, a trend line, or a moving average. In an oscillating trade, it's the fixed lines, the straight ones. So horizontals and trend lines. So they're not looking at a chart and seeing this. The smart money's seeing this. So flash crash, typical example, straight down, hit this horizontal level that it had recovered from before, straight up. These are the levels we want to be aware of when we have sharp oscillating moves. So when we're dealing with oscillating trades, again, we're not waiting for a stock to continue to start moving in a direction to buy it. In a momentum trade, we're waiting for something to go up first before we get into it. In an oscillating trade, we're expecting it to ricochet back and forth between these lines. So our key is trying to find the strongest point that it's likely to bounce at. So we're looking for basically something where when we look at the chart, we can see that a stock has shot straight down, hit a price, and gone straight back up again. So if you saw something that traded $30, $40 million a day of volume, something substantial, and it plummeted 20%, in 5 days or something, and then and most people would be terrified of that. Me, I would be rubbing my hands together because I'm waiting for the level to be hit where some kind of big power comes in. So if we can find that, where that point is where it stops and shoots straight back up, that tells us that the only way something that's trading $30, $40, $50 million a day can instantly stop from a massive downtrend and go straight back up in the opposite direction, you need to have some real damn power to do that. The kind of power that comes from, let's say, 80% of the volume deciding to suddenly buy, right? Which is algorithms. So when we see that level, it's really, in my opinion, only explained by algorithmic buying. And the opportunity there is that the next time that level's hit, it's very likely to happen again. So we see this aggressive bounce. We're now just waiting for this level to come about. Now, so for the rest of the few months, you might see a little bit of oscillation, bounces back and forth, and we don't care about any of that. These are small, weak movements. Could you make money? Yeah, you're making chump change though. What we want to be looking for is the highest probability. So we're waiting for a recurrence of the strong, aggressive reversal to occur again, and that's where your trade is. So when I look at a chart and someone says, what would you do with Twitter? Or what would you do with Apple today? 99% of the time when somebody asks me what I would do with that stock, I would say nothing. Because I'm not going to try and compromise my strategy to suit the stock. What I want to know is which stocks out there on a given day suit me. Think of it like playing poker. If you could play poker and only ever play aces, that's the only hand you ever played, you would, wouldn't you? Obvious answer. Why can't you? Because you have to pay blinds. Because if you sit there for an infinite amount of hands waiting for pocket aces, you'll eventually go broke on paying the blinds. In the stock market, you can. You don't have to pay any blinds. You get to look at the chart for free. So if you know what aces looks like, you can analyze 8,000 stocks a day, waiting for those aces to come, and those are the times you trade. So we're waiting for, in an oscillating trade, this is aces right here. When we get a sharp, aggressive drop previously, sharp, aggressive rally that happens very quickly, not a nice, not rounded like that, don't care about that. And we want it to be fresh. So we want it to only have happened one time before, maximum of 2. And I call that the rule of 3. So if it's happened 3 times, it's no good anymore. So you only want to have seen it happen once or maximum of twice before. I'm going to be showing you actually some live stocks here in a moment where that's happening right now. Let's go back to my cursor. Here we go. So in this chart, if somebody asked you what you would do, The best trade here would be to buy at the bottom, because that's the most aggressive and that's the freshest, followed by this top here. Okay, so that's oscillation. Here's an example. Aaron's. This is an oscillating trade. Sorry, I missed the question here. Over what time period? It just depends on how you're trading. This could be true if you're trading in an hourly time frame. You'd be looking at hourlies. If you're trading a swing trader and you're looking at daily charts and you're in and out of a stock in a week to 3 weeks, it could be as much as a year that could go by. By twice, do you mean the 2 low points on the last chart? By twice, I mean if a stock dropped from 15 to 10 and shot back up to 15, and then it went back to 10 again and back up to 15, and went back down to 10 again and back up to 15, that means it's tested that support of $10 3 times. And what do you think most people do? They see that something's gone from 10 to 15, 10 to 15, 10 to 15, 10 to 15. What do most people do? Most people say, "Oh, I'm going to buy next time it hits 10." And they wait to see it happen 3, 4 times, because that's what gives them confidence. Now, the smart money knows this, so they play on that. That's why people lose money and smart money makes it, because the 4th time the stock comes down and hits that support, all the Joe public goes out and thinks they've figured out the pattern, how it's so clear, $10 is unbeatable, and they load up on it, and that's when the smart money shorts it into that flurry of buying from the retail. And that's why people lose money, because they're trading emotionally. So we've got to go back to rules. We don't want to see that support tested more than 2 times if we're going to trade it on the 3rd. And after that, it's done. So Aaron's, great example, huge rally here from 24.50 back up. Huge rally again, 24.50 just a few months later, right back to the exact same price you can see that it rallied to before. You might then notice a similar type of action. Aaron's comes down, hits 26.50, and again a very, very dramatic rally that can only really be accounted for if the smart money is behind it, because that's where the volume's coming from, and that's a huge move for a stock that's trading 30 million plus a day. So the next time that a situation rolls around, months and months and months later, don't really care about all this stuff in between, because we're waiting for our aces again. And it comes along here, rallies up, it's a second test, and then again your 3rd test, and another huge rally right up from 26.50 to 32 bucks. Now if you want to go and have a look at what's happening right now, this is a great example, because this same kind of setup just occurred this week. And I'll switch over to the chart. Here's that same stock, Aaron's. And if you look, we had a substantial rally originate from this price here. The stock went straight down, some aggressive tops here, hit 28.75, and then went straight up in basically without really much oscillation at all, went straight back to $33. So we've got about a close to 15% rally over 2 weeks. Stock plummeted. You can see a very dramatic drop. As the stock dropped, you can see the candles contracting, which of course is a falling, showing a decreasing amount of eagerness to sell. And we hit the exact same bottom that we originated from before, and have rallied strongly off of that. So for an options trader, think about how cheap the premiums are buying $30 calls when a stock is knifing down like that. And those kinds of reversals, you can pick up 20, 30, 40% gains in just a couple of days on very cheap options. If you want to have a look at another example last week, here's STX, Seagate. Same thing, rallying into this sharp, aggressive, smart money sell zone on oscillating basis. And those options, the 57.50 July puts, went up from 35 cents overnight to 56 cents just from that day drop to there. So you're looking at about almost a 75% return overnight on a 24-hour period on that drop of 2.97%. And even more if you continued to hold. Okay, so this is what I mean by smart money sell zones. And we're going to be looking, well, depending on how much time we get at the end, we can bring up quite a few more. So there's Aaron's, which is kind of active right now, and there's an STX, which was one of those picks from last week, following that basis. So the smart money then, the oscillation is all about levels, knowing where think of it like a children's coloring book. The bars are the crayon, it's the color, and that coloring in is between the outlines that makes the pattern. And when we know where those lines are, that's what gives us timing of where we can get in with very exact precision and therefore have very small risk by placing tight stops and by having by getting in very close to support that then also maximizes our return. So for example, I'll just use Aaron's as well before we move on. With a trade like this, you look at the low of this candle was 28.57. The low here was 28.35. So you've got basically a very kind of tight area that you can get in at. And look at, say, a 20-cent stop for what's already almost $1 profit. So you're looking at a 5-to-1 risk-reward ratio as it closes in on the likely target here, where it will might experience some resistance here at $30. Looking about a $1.50 rally for a 20-cent risk. By anyone's standards, 7-to-1 is a great risk-reward ratio. You can get one of these right and 5 of them wrong and still come out ahead. Just a quick question. The second hit is defined by the first hit. How do you respond to a first hit that had never been defined? The best way to, you can predict where the first reversal will be through Fibonacci's, but in most cases, it's a much more difficult for the benefit you get trying to forecast a level that hasn't yet been defined. It is possible, but it's more difficult. So I generally, for ease of trading and probability's sake, looking for that second bounce is going to be the highest probability trade. Okay, so now let's switch to momentum. We've talked about the oscillation. So momentum is the opposite sides of the market. Momentum is where we look at, say, for example, something like Chipotle Mexican Grill. Let me just delete these lines. And this is actually a scenario where you can see the change from oscillation to momentum. So here you can see Chipotle in basically a downward channel. I'll just take these moving averages off because in a oscillating chart they don't work. So you can see this downward channel with also another trend line here as well. So all we need to know to make money on this stock in this scenario is where this top end line is, so that when we run into it we can short it each time. Or maybe we're not even trading the channel, but this is what's controlling the movement of the stock, and therefore then we know how to trade it if that's a pattern that we like to specialize in. And as the stock then moves on down, we can see that it then breaks out, continues to oscillate sideways. And how do we know it's oscillating? Because if we add the moving averages on, the 9 and 20, you can see that the stock basically moves back and forth between the 9 and the 20, here, here, cuts through it all through here. Basically the moving averages they don't have any spine. The stock isn't coming to a complete stop every time it bumps into one. It's more limited by the boundaries of this channel. Until now, until here on the 23rd of May, which is, by the way, when the entire market went from oscillation to momentum. We'll come back to that. Dow Jones Global Index, a summary of all the indexes around the world. Again, you can see that. Oscillating, 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 oscillating. Right here, 23rd of May, bang, broke out, momentum. So this is when the shift happened, and you look at Chipotle. So the moment that we see a shift from oscillation to momentum, we stop trading double tops. We stop trading reversal trades. We stop trading double bottoms and these types of things where we're bouncing back and forth. Now, when we're in momentum, now we look for the breakouts. We don't expect the stock to break. To reverse off resistance. We expect it to smash through resistance. So we're looking for longs that are breaking out, for flags, for cup and handles, things like that. And so Chipotle was a great example of that, where we could see quite clearly that the market had gone from oscillation to momentum. So we started looking for any stock that was approaching resistance where the smart money was loading up, where basically that momentum was building fast. And so right here was the perfect opportunity to go long Chipotle. And as you can see, I mean, that did really well, and it just ran up. It didn't oscillate like it did before. It just climbed up this moving average like it's climbing a mountain. And that's right, exactly. You can see the third bounce was when it broke out, that rule of three. You'll see the rule of three on everything. I mean, like, if you think about your ascending triangles, what generally happens? It's usually 1, 2, 3, and either breaks there or the next time. Look at any number of ascending triangles, you'll see the rule of three continually occurring. So the trick now to tie this all together, when you start to see when you start to look at oscillation versus momentum, the trick to really empowering then this strategy is then going back to where the smart money is going. What are the big boys with all the resources and all the funds, what are they doing? Because if the market is oscillating, they're going to be buying at the bottoms and using the tops to lure other people in to sell to. So you're going to get heavy buying on the top, and they're going to be distributing or selling off their position as it rallies. If the smart money, however, believes or is coordinating this stock to not break, not reverse, but to continue going up, then the smart money is going to load up at the bottom and not sell on the way up, but actually accumulate more, perhaps. And so when we're talking about understanding how the smart money works, we come back to a classic question of what is an uptrend, right? And I ask this question in every webinar. Maybe you want to throw the answers up. What is an uptrend? You saw it in one of my slides earlier. It's higher highs and higher lows. But I don't agree with that necessarily. It's the textbook definition. But what if a stock's doing this? What if a stock's making higher highs and higher lows and contracting in the range? Well, that would indicate a rising wedge where a bearish move is about to happen. So while it's maybe technically an uptrend, it's not an uptrend I'd want to buy, so why am I even interested in it? An uptrend is higher highs and higher lows on higher volume and closing in the top half of the range. And if you think of all the classic indicators that people use, that's exactly what they look at. What does a stochastic do? A stochastic tells you the stock's ability to close in the top half of the range. What's directional movement do? It tells you if the stock's making higher highs or higher lows. Volume, of course, tells us if that's increasing or not. So if all of these things are happening, so traders will litter their screens with all these indicators, but what all of that's just telling us is one simple question. Is there actually an uptrend in place where there's volume that supports it? And so I like to look at money flow to tell me that. And you can see here at the bottom, this is what ultimately tells you, is there real momentum or not? Because this summarizes all those variables that I just talked about into one. And you can see here that as we went lower in price, the smart money was accumulating. We have divergence. And that, as soon as it breaks through zero, that's then also a confirmation buy signal at the same time that it broke the trend line. And so here is a perfect momentum trade. Let's look at a couple of others. Now, INFI, great example. 5 minutes left here. Great example, INFI. Stock was oscillating. You can see it's bouncing back and forth in a consolidation triangle. I've had traders tell me, oh, consolidation triangles are terrible because, you know, it's basically a 50-50 shot. It's going to go one direction or the other. Not so, because the direction it's going to go will be preceded by the smart money. If the smart money starts loading up and they're going to do a big buying push, that's going to be what sends it up. Versus if they're selling the hell out of it and then the buying completely evaporates, it'll shoot down. So shouldn't we look at the smart money? And here you can see an oscillating trade that as it oscillates, increasing money flow. This was an easy pick for us from $9 up to 11. You got a 20% rally in just a few days. Wasn't difficult. This also, by the way, coincided with massive insider buying from, I think, one of their, was either their director or CEO. There's numerous examples. If you look at CF, one of our picks last week, these options went up from 475 to 870 on the August 250 puts, 100% return overnight. It was easy. How was it easy? Again, oscillation. This stock did not listen to its moving averages at all, so you don't pay any attention to the MACD and all that kind of stuff. All you're looking for is what is limiting the chart, its sideways movement. And here you could see that despite potash, which is this sector stock's in, being terrible, this stock was actually not dropping. Potash was dropping. The entire industry, the double agricultural fund dropping. All of it looking terrible. But this was going sideways. And not just sideways, but the smart money was loading up. And there was an easy long that even though counter trend to the market and sector, this was a quick 100% in and out if you had picked up those 250 calls or just traded the stock. So we're coming to the end of the presentation, so I'll quickly show you because there's a lot to talk about. This is really, and it all comes back to if you can marry up the right pattern to the right smart money pattern and then therefore know exactly what you're looking for. That's the key to everything we do, is just looking for where the money is going and what the pattern is that's holding the stock. And then we just get this consistent trade plan in place. And this allows us to be efficient. You know, we might miss a trade or two by not looking at the market all day long, but who wants to look at the market for 12 hours a day? The idea here is to start when we knowing what to look for, when we know what the pattern is, oscillating or momentum, we know what the smart money is that we want it to do, we can then build scans. And that is what we do. Our specialty, and the cornerstone to our success is having scans that look for these things exactly. The last few trades, CF, INFI, Twitter, they were all found within minutes. A quick scan, 10 stocks came up, we eyeballed each of them for what we were looking for, and were able to pick those out. I'll quickly summarize here, we've just got about a minute left. We are doing a workshop next week where we actually give you the scans and the indicators that identify the smart money. It's about 2 hours long, and we're going to be going through basically a full-on workshop live, and all of the recent trades we found with the scan, ones that have worked, ones that have failed. We'll be giving you the scans and the algorithms behind them. so that you can go and program them into your own software, but we do have them pre-programmed, scans, for Think or Swim, TC2000, Incredible Charts, and Metastock. So if you're using any of those programs, we actually provide you with the formula and downloadable files that will install our proprietary smart money indicator into your program, as well as show you how to set it up on free programs as well. And then you also have included the actual scan itself that works in all of those programs also, that will locate those opportunities, which is the really high value stuff. So we're at the end of our time. If you do have any kind of questions, you can just go to our website, contact us from there, or call us. We have a team here in the office for the next 3 hours. They will be able to answer any of your questions. And thank you so much for having us on today.
Great. Thank you, John, for that wonderful presentation. Once again, that was John Seville from Acorn Wealth.